So the closing bell is about to ring. Well, it will in 43 minutes anyways. We count you down to the close. We'll take a look at a little thing we call our heat map, and there's plenty of heat today, at least if you like stocks going to the upside. I know we're off the highs, but there's only three at the bottom right of your screen there. What, Merck, Coke, and Chevron that are down. The rest of the Dow 30 are all up, and we're up to 100 there before we broke, and now we're only up 150. On the markets. Keep it here. We don't know how we're going to close. We never do, but especially lately, the last half an hour has been anything but boring. But the market's seeing these triple-digit gains, today, and only 5 S&P 500 stocks still in bear territory for 2015, to give you a little bit of a broader perspective. So what's next? Will we continue to see the movements like we've seen? What about Friday's jobs report and how that works into things? We're joined now by Jeff Reeves, InvestorPlace.com, where he's executive editor, and Washington Crossings advisor, portfolio manager, and market strategist Kevin Caron also joins us. So, Jeff and Kevin, it's good to see both of you. I don't know if you heard our last segment, but even if you didn't, you could fill in the blanks on a market where, as I said right before our break, nobody knows nothing, and that was just about the Federal Reserve. But you could talk about China or, any number of topics that are in the news lately, and someone's prediction is going to be totally different than the next person. How are you handling this environment, Jeff?
Well, I think you're right. Basically, anywhere from here, nobody knows. So I think the important thing to do is for investors to be patient, kind of watch and wait, digest what you see. I think the jobs report on Friday is going to be a big deal. It's also important to acknowledge the fact that China's markets actually closed for a holiday, so we're not actually getting some of the volatility from China. So we don't actually get any action there to kind of digest on our end. So it is important to wait and see. I know it's hard, but I think we're going to get a lot of clarity in the next couple weeks, just maybe not tomorrow.
Yeah, maybe not tomorrow or the next day, and we won't have any, Kevin, as is pointed out by Jeff, any markets in China to play off of, which has kind of become the daily thing to do when everybody gets up in the morning. What do you expect here heading into the jobs report on Friday?
Yeah, I expect a number that's decent. Most of the data we've seen here in the United States has been getting better, but really it's not been a United States issue. What we've been seeing is a situation with global growth. All of the problems seem to be outside our borders. Most of the places that you look at, whether it's places like Brazil with their currency, which has basically cratered in the last several months, when you look at growth rates in places, even places like Canada has now have now been through 2 negative GDP prints the last couple of quarters. What we're seeing is the U.S. remains an island of prosperity, and most of the issues are coming from outside our borders, which frankly creates a bit of a dilemma for the Fed, who tends to focus their attention more here in the United States, as evidenced by the comments we got in the Beige Book today.
Right, which we were just talking about, that we won't get into them again here. We talked with our last guest, and, on balance, it seemed like there was a lot of positive things in there, although some issues as well. Certainly, some of those issues, as is rightly pointed out by Kevin, Jeff, do come from outside our borders. So what do you think is priced in right now in this market? How much of a slowdown in China, for example, is priced in the market right now after all that we've seen?
Well, not to throw out the old platitude, but it is a market of stocks, not a stock market. And I think that it's important to recognize certain sectors, I think, have kind of seen an influx of capital, perhaps because investors think they're quote unquote safe. Like domestic utility stocks, for example, have no exposure to what's going on overseas. They're basically legalized regional monopolies. But do you really want to pay a forward PE of 17 or 18 for a utility? Maybe not. So I would actually kind of caution folks about thinking that, the kind of growth is priced into the growth stocks, safe is the way to go, because a lot of these safer consumer staple plays or what have you, utility stocks, they may actually be overvalued because people have started to go a little risk off right now. I actually wouldn't be afraid to slip a couple jabs in some of the stocks that are beaten down. There's a bunch of Dow stocks that actually are already in a bear market, down 20% or more. Since the correction. So, if you're a long-term investor, again, and you're willing to be patient and ride out the volatility, I would caution against maybe just running for the hills and going for these quote-unquote safe names. They may not be as safe as you think they are. I actually think instead of just being priced in, there actually is a bit of a premium you'd be paying for these stocks right now.
That's interesting. So some of those do look expensive. Jeff and Kevin, thanks to both of you. Now